Health insurance premiums are rising across the United States, and for many working professionals, this steady increase is becoming a long term financial pressure. Unlike housing payments, which are tied to a specific property, health insurance costs move with age, employer plan structures, medical pricing trends, and broader insurance market dynamics. For mid career professionals, especially those in their 40s and 50s, health insurance often becomes more expensive at the same time other fixed expenses are already layered. This shift does not usually arrive as a single dramatic spike. It appears during open enrollment. A revised premium contribution, a higher deductible, a change in coinsurance percentages. On paper, the change may look incremental. Over time, it compounds. Across employer sponsored plans in the US, total premium costs have trended upward for years. While employers absorb a portion of the cost, employee contributions have gradually increased, either through higher payroll deductions, higher deductibles, or narrower provider networks. For many working professionals, especially those supporting families, this creates a dual layer structure. Monthly premium contributions, potential out of pocket expenses. Premium growth is only part of the story. Deductibles have expanded significantly over the past decade. Many plans now require several $1,000s in out of pocket spending before full coverage applies. Coinsurance structures often mean employees pay a percentage of certain services even after meeting deductibles. This shifts more financial responsibility to households. In midlife, healthcare utilization typically increases compared to early career years. Preventive screenings, specialist visits, orthopedic concerns, and prescription needs become more common. Even when coverage remains stable, usage frequency can increase total out of pocket exposure. This creates a layered effect: higher premiums, higher deductibles, higher utilization. For professionals, balancing mortgage payments, property taxes, maintenance costs, and retirement contributions, health insurance growth becomes part of the broader fixed expense expansion pattern. Employer dynamics also influence cost structures. Some companies adjust plan tiers, encouraging high deductible health plans paired with health savings accounts. While HSAs provide tax advantages, the short-term effect can be increased upfront exposure before coverage begins. Other employers shift more premium cost sharing to employees during annual renewals. These adjustments are typically communicated in neutral corporate language. Yet, they reshape household budgeting over time. Another factor is dependent coverage. Family plans often increase more noticeably than individual coverage. As children age into teenage years or young adulthood, healthcare utilization patterns shift. For professionals supporting families, insurance becomes a larger line item inside total compensation trade-offs. Healthcare cost inflation also remains structurally elevated relative to general inflation. Hospital systems, pharmaceutical pricing, specialist services, and medical technology all contribute to underlying cost growth. Insurance carriers price policies based on expected claims exposure. Even when an individual household has a low usage year, premiums reflect pooled risk across broader populations. This can create a disconnect between personal experience and premium increases. Many working professionals feel financially stable in their careers. Salaries may have grown steadily over time, but insurance costs often rise at a pace that narrows the net effect of income growth. A raise that appears meaningful on paper may partially offset higher health insurance contributions. Over a decade, this subtle erosion can reshape long-term savings capacity. For mid-career households, accelerating retirement contributions in their 40s and 50s, this timing matters. Health insurance costs do not disappear with employment transitions either. Professionals who consider career shifts, consulting roles, or early retirement must evaluate insurance independently through ACA marketplaces or private plans, often at significantly higher premiums. This reality influences career decisions. Insurance cost growth therefore interacts with income structure but remains its own cluster because it is driven by medical pricing, actuarial modeling, and employer benefit design. Another long term consideration is age based pricing adjustments in certain markets. While employer sponsored plans smooth some variation, marketplace plans often price based on age brackets. As professionals move through their 40s and 50s, premiums naturally rise within those bands. This is structural, not situational. Healthcare cost layering becomes particularly visible in midlife because it overlaps with higher housing costs, retirement catch up contributions, college tuition exposure, insurance premium growth across multiple categories. Health insurance often feels administrative. It is chosen once a year. Documents are stored. Payroll deductions continue automatically. But beneath that routine is a consistent upward trend in total system cost. It is important to separate crisis framing from structural analysis. Health insurance growth does not necessarily indicate instability. It reflects the broader US healthcare pricing environment, which has historically increased at rates above wage growth in certain periods. For working professionals seeking long-term financial clarity, recognizing insurance as a dynamic expense, not a static benefit, brings perspective. Employer coverage remains a valuable part of compensation, but its cost trajectory matters. As midlife professionals plan for long-term financial sustainability, insurance becomes one of the most persistent upward moving components inside the broader expense structure. Unlike discretionary spending, it cannot be easily reduced without altering coverage levels. And unlike housing, which may eventually be paid off, health insurance remains necessary throughout working years and into retirement. Understanding this pattern allows households to interpret annual premium increases not as isolated events, but as part of a structural cost trend. For many American professionals, the central financial story of midlife is not income decline. It is expense layering. Health insurance is a key part of that layering. And its steady growth is reshaping how working households evaluate compensation, savings, and long-term financial stability.